natural gas futures are hovering near the pivotal $3 threshold, with September contracts inching higher early Tuesday following Monday's steep decline. Traders remain on edge, closely tracking both short-term weather developments and key technical levels that could tip the balance. August contracts, set to expire Tuesday, briefly dipped to $2.98 before rebounding above $3.03 during morning trade. Although bulls are making a stand at this crucial support zone, the sharp 60-cent drop since last week has reintroduced significant downside risk. Analysts continue to highlight the psychological weight of the $3 mark, cautioning that a decisive break below could trigger a wave of stop-loss selling. U.S. futures climbed to $3.11 as forecasts for intense August heat raised near-term demand prospects. Meteorologists anticipate above-normal temperatures across large swaths of the country, particularly the Southeast, Mid-South and Midwest, likely fueling stronger air conditioning use and lifting gas consumption in the power sector. Nevertheless, rising U.S. supply continues to limit upside momentum in natural gas. Dry gas production reached a record 108.6 billion cubic feet per day on Monday, up 4.1% from a year ago. While domestic demand has increased 11.5% year-over-year and LNG feed gas flows reached 15 billion cubic feet per day, strong output is offsetting these supportive factors. Meanwhile, WTI crude rose to $69, which is a bearish signal for gas prices since about 30% of U.S. gas production is tied to oil drilling. If oil prices remain elevated, it could ignite a further surge in gas output, as producers ramp up drilling activity in oil-rich basins where natural gas is a byproduct. With nearly a third of U.S. gas production tied to oil extraction, sustained high crude prices would likely accelerate an already aggressive production pace. This could unleash a wave of additional supply into an already saturated market, overwhelming current demand and putting heavy downward pressure on prices. In such a scenario, a sharp drop toward the $2.50 level would not only be possible but increasingly likely, as the market struggles to absorb the excess volume. September futures rose about 8 cents to trade around $3.07 on Tuesday, though they remained within Monday's range, reflecting market indecision. With momentum still tilted to the downside and rising production weighing on sentiment, the near-term outlook stays bearish unless bulls can firmly defend the $3 level. A break below $3 would likely pave the way for a retest of $2.88, while overhead resistance limits the potential for sustained rallies. On the upside, any rebound could trigger short covering, but resistance is likely at the $3.25 pivot, with stronger barriers near the 50-day moving average around $3.45. Please like, subscribe, and comment to support the channel. See you in the next one.